We here at Food Theory are McFans of the Golden Arches, but McDonald's is arguably one of the most influential restaurants in history. So, there's gonna be a lot to say about them, and they're about to make history yet again. This time with their ice cream machines. Why are these things always broken? What if I told you that there's a conspiracy behind that broken machine? An actual, fully fledged corporate conspiracy that goes all the way up the ladder.
I have a confession to make. I love McDonald's ice cream. Living in the Bay Area where there is an artisanal ice cream shop around every corner, the McDonald's frozen treat still holds a special place in my heart as a treasured guilty pleasure. However, if McDonald's ice creams are famous for anything other than their flavor, it's how their machines are always broken. Being disappointed by the unreliability of these metal boxes is such a common phenomenon that it has become a part of online culture, complete with its own memes and dedicated websites to match. That begs the question, why is a multi-billion-dollar corporation failing at something so seemingly simple? Well, if you research online, the explanation turns out to be rather boring. The machines were so over-engineered to meet McDonald's desire to have one machine make all their frozen desserts that its complexity made it prone to malfunctions. That is a reasonable explanation, if not a bit dull. However, according to popular YouTuber MatPat, there is a deeper level of conspiracy behind everything. He argues that the unreliable nature of the McDonald's ice cream machines is nothing short of a corporate conspiracy orchestrated by evil Wall Street tycoons, manipulating the entire fast food industry for their own profit.
Wow.
That's some serious accusation to say the least, and if he's right, then that means my beloved McFlurry is being held hostage by the moneyed interests. Fortunately, that accusation is also false. In this video, we will dive into the recent Food Theory episode, examine its arguments, and prove that, no, as terrible as Wall Street can be, they are not the reason behind the ice cream machine's reputation for poor reliability. The central argument of MatPat's video can be simplified to this. Both McDonald's and the ice cream machine maker Taylor are public companies, and Taylor makes a large chunk of profits by charging fees anytime their machines break down and need to be serviced. Given that both companies share the same Wall Street shareholders, they must be conspiring to keep the machines broken in order to keep Taylor's maintenance fees flowing. The theory sounds plausible, convincing even. To dismantle its underlying logic, we first need to examine the characteristics of the top shareholders in both companies. These are firms like Vanguard and BlackRock. A quick Google search tells us that while these are indeed investment companies, they are primarily index funds, not hedge funds or traditional mutual funds. This distinction might seem arbitrary to the untrained eye, but their special status makes them a very unique type of investor. I'm willing to bet that you have heard of the S&P 500 and know that it is an index often referred to as the general barometer of the U.S. stock market. It is essentially a list of the 500 largest publicly traded companies compiled by the research firm Standards & Poor's, who both created the index and is responsible for its periodic rebalancing. As the S&P 500 saw widespread adoption over the years, many people decided to avoid the hassle of picking individual stocks and simply invest in the index as a low-hassle way to participate in the general stock market. This is a pretty sound investment strategy, as research has shown that the S&P 500 has regularly outperformed the vast majority of stock pickers and professional investors over the long term. However, because the companies in the S&P 500 are so large, many of them have stocks trading in the hundreds, even thousands of dollars per share, and buying one share for each of the 500 companies would cost close to $1 million, which is impractical for the normal person. To solve this problem, index funds were created as a way to pool the funds from many small investors together in order to efficiently replicate the S&P 500. This means that index funds are passive investors who make zero investment decisions themselves. They purchase stocks in the same fashion as the S&P 500 or some other index and do nothing else. You can think of them as your reflection in the mirror. While it can move around, it has zero control over its movements. Or at least I seriously hope so. Accusing these passive funds of shady manipulation has the same level of logic as charging a reflection with murder. The reason why McDonald's and Taylor both share top investors is simple. Both companies are included in popular indices, making them a necessary component of the numerous index funds managed by firms like Vanguard and BlackRock. These two companies sharing top investors is a byproduct of the index fund industry, not a purposeful decision made with ulterior motives. Not to mention that even if top shareholders like Vanguard were malicious, it would be supremely idiotic for them to risk their $15 billion investment in McDonald's for their much smaller investment in Taylor, which totals less than $1 billion. I also wanted to quickly address MatPat's idea that
the success or failure of these companies is very closely tied to their relationship with the Golden Arches. When McDonald's expands, Taylor sells more equipment. When they close restaurants or people buy less McDonald's, Taylor feels that pain too. We can actually see this in the stock prices for both these companies. Taylor's parent company is Middleby Corporation, so that's whose stock price we're going to be looking at here. And as you can see, in 2020, when restaurants like McDonald's were hard hit by the pandemic at the end of February because everyone was eating at home, no one was going out, and no one was opening new restaurants with new equipment, Middleby's value tumbled too. When McDonald's lost about 30% of its value in a few days, Middleby was right behind the following week, losing 50%. Basically, what you're seeing here is evidence that the shareholders wait to see what happens to McDonald's, and then that directly affects the stock prices of Middleby.
this is an obvious case of confusing correlation with causation. The crash in the stock prices of McDonald's and Taylor happened in March 2020. As you might remember, that was when a certain virus coming out of China was beginning to spread around the world. These two stocks fell together not due to some hidden agenda, rather because the entire stock market plunged as investors got spooked. Look at it another way. We can see that Microsoft also crashed in March 2020 along with the stock of McDonald's. However, that would not be very convincing evidence for us to draw the conclusion that investors were conflating the sales of McDonald's fast food with the profitability of Microsoft software. This is not to say that MatPat was wrong in thinking that investors judge Taylor's future based on McDonald's prospects. To a certain degree, this is probably true. However, that would be better proven by data such as the long-term correlation between the two companies' stock performances, rather than a sudden short-term crash in their stock prices, driven almost entirely by a third-party variable, such as a global pandemic. It is always difficult to call out the mistakes of top-notch content creators, especially so when you've been a long-term fan. I started watching MatPat in 2013 and became a monthly donor to St. Jude Children's Research Hospital, precisely because of MatPat, Stephanie, and the Theorist team's enormous fundraising efforts. Their use of the popularity to raise millions of dollars in the fight against childhood cancer has genuinely earned my deepest respects. If you take away anything from this video, I hope it is the need to avoid jumping to conclusions, even if the evidence seems convincing at first glance. The best and only way to truly understand something is by digging beyond the surface level and getting to the root causes. Otherwise, even if you are a Diet Coke chugging, musical loving, number crunching theorist king, you might still end up coming to the wrong conclusion.